Today is the 3rd of June 2020. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500 and discussing what the cycles have to say about what is happening there. And I'm also going to make a few comments about the concept of common sense and how that relates to the financial markets. Before we take a look at those markets, I must ask you to please make sure that you have read and understood these disclaimers. I'm going to start the discussion today with the analysis that I presented at the end of the previous market update video, which suggested that the trough that formed on the 23rd of March might be the trough of the 54-month cycle that we were expecting to happen in about the middle of June. So we are now in June, and so this analysis seems even more likely than it seemed at the beginning of April when I first suggested it as a possibility. Funnily enough, I was accused of being irresponsible for suggesting this, but it was certainly a possibility. And if you take a look at that previous market update, I explain how the cycles needed to have been running shorter than we normally expect according to Hurst's standard nominal model in order for the very big magnitude trough to have formed towards the end of March. So the first thing I'd like to say is that this analysis is by no means the only and absolutely certain analysis that is playing out. The previous analysis that we were looking at is still possible. And I am going to loop back and I'm going to take a look at that analysis again, because that analysis carries a fairly serious warning in terms of the markets potentially moving down even more strongly in the near future. But I'm going to start the discussion with this analysis because certainly this analysis has made some sense out of what has been happening in the markets. So let's take a quick look at the analysis and see what it implies. First of all, of course, we've got the big 54-month cycle trough on the 23rd of March. So that's a 4.5-year cycle trough. Of course, we expect markets to bounce fairly strongly out of that trough, and we expect markets to drop fairly strongly into that trough, which is pretty much exactly what happened. And so this certainly becomes a very viable analysis. However, it does require that the cycles are a good deal shorter than normally expected. And we'll take a look at that in a moment. But what I would like to do quickly is show the composite model line. Now, the composite model line always causes comments to be placed under these videos, largely because people don't really understand what the composite model line is, and so I feel I should explain it in a little more detail. The composite model line looks like a forecast for price, and that's one of the dangers of it, because it's not strictly speaking a forecast for the price. It can be misinterpreted in that way, and I would like to encourage you not to do that. The composite model line is a result of taking all of the information gathered from the analysis. And here is the analysis at the foot of the chart. Sentient Trader, of course, uses Hurst's notation of marking the positions of the troughs by using diamonds. Now, for an experienced Hurst cycles analyst, you can look at a chart and you can see those diamonds and it makes some sense to you. But for somebody who might be new to the Hurst cycles approach to the market, seeing all those diamonds at the foot of the chart will perhaps not really make any sense. And so that is why I created the composite model line. What it does is it takes all of the information in this analysis in terms of the wavelengths and the amplitudes of the cycles that have been found in the analysis. It then recomposes, recombines that information to produce this line. So that is the line that we are seeing in the past. It is a recomposition of the cycle information. The amplitude and the wavelength of each and every cycle found in the analysis has been recombined. And so when you look at the composite model line in the past, it is showing us what this analysis at the foot of the chart implies would have happened in price if the only thing that was influencing the financial market were the cycles that had been found in the analysis. And of course, we know that's not true, because there are many other things that influence financial markets and which will cause anomalies between the composite model line and the price action. And you can see several of them on the chart over here. Periods of time where the composite model line and price diverge fairly strongly from each other. And you will always find examples of that. When looking at the composite model line in the future, the software has made a deeply flawed assumption, and that is a very important thing to bear in mind. The assumption that it has made is that the cycles that it has found in the analysis are going to continue beating with the same wavelength and the same amplitude. And that is a deeply flawed assumption because, as we know from Hurst's principle of variation, the cycles that influence financial markets are dynamic. They are constantly changing. Their wavelengths are always changing, and their amplitudes particularly are always changing. And so it's a flawed assumption. It's very tempting to look at this line on the chart and say, well, clearly that's where price is expected to go. But it's not really as simple as that. So how can we use the composite model line if it isn't a direct forecast? How can we use the composite model line to make better informed decisions about our trading? Well, what the composite model line does do for us is it interprets this cycle analysis at the foot of the chart. And it tells us what to expect, not necessarily in terms of the absolute level of the line. You know, here you can see the line is a little bit higher than price over there. So in other words, the composite model line is suggesting that we're going to see a higher price over here fairly soon. But that is not the meaning behind that line. Where it does become meaningful is in the structure of the line. So let me zoom in just a little bit and show you what I mean by that, so that we can hopefully use this information to better understand what we are seeing on the chart. So what I mean by structure is that when the composite model line is moving down, that tells us that the cycles that are currently to be found in the market are likely to influence price to move down over that period of time. When the composite model line moves up, that indicates that the cycles are likely to move the market back up again. And then when it moves down, we're going to see it moving down. And all that the composite model line is doing is, in fact, interpreting the information that we can see at the foot of the chart. That's really all it's doing. So here you can see the next nest of lows for the 20-week cycle trough is expected in the second week of July. And the cycles are expected to bring price down into that trough. Then price is going to bounce out of that trough. And the combined effect of those cycles is likely, according to this analysis, to bring prices a little bit higher than they were prior to that 20-week cycle trough. And then we're going to see a move down into the 40-week cycle trough here at the end of October. So the composite model line is very useful in terms of understanding the structure of the market, when we expect it to move up and when we expect it to move down. It's also a useful line in terms of comparing what has happened before. So over the most recent period of time, as you can see, ever since about the middle of April, the composite model line was moving higher than price managed to do. I think that's fairly obvious. There's a big discrepancy between the level of the composite model line over there and the level of price over there. Now that discrepancy is not accident. That is an important thing to notice. So what it is telling us is that the cycles that have been recently active in the markets, assuming this analysis is correct, because of course it is based upon this analysis, those cycles were expected to carry price higher than it managed to reach. So what does that indicate? Well, it indicates that either there might be something wrong with this analysis, or perhaps there is something else that is pulling that market down. Although that seems a strange thing to say, considering how very bullish the markets have been. But it's a really important thing to take notice of. So let's zoom in here and discuss these shorter cycles and what we are expecting next on the basis of this analysis. And I'm going to display the 20-day FLD, which is a very useful FLD in my opinion. So first of all, you can see that since the 54-month cycle trough formed on the 23rd of March, we have an 80-day cycle trough which formed over here. So let's just measure that, and you will see that I think it's 52 days. There we go, 52 days elapsed. Now, the average length of an 80-day cycle is 68 days. If that confuses you, then make sure you download the free PDF which explains the core concepts of Hurst cycles, and you will understand why the average length of an 80-day cycle is in fact 68 days. So 52 days is really very short. It's basically 16 days short, and it implies that the cycles are running very short. As I mentioned in the previous market update, in order for this analysis to be valid, that is an assumption that we need to make, that the cycles have been running short. And you can see, if you take a look at the bottom right hand side of the chart, you can see the recent, what we often refer to as the current wavelengths of these cycles. And so, for instance, the cyan colored cycle, which is the 80-day cycle, is showing that it has recently been running at about 56 days long. Now, the average length, as I've mentioned, is 68 days. So you can see that recently that cycle has been running very short. So this analysis is making the assumption that the cycles have been running short. Not impossibly short, but they have been running shorter than we would normally expect. Now, what are we expecting next according to this analysis? Well, we're expecting a 40-day cycle trough sometime in about the second week of June, and we're expecting a 20-week cycle trough here in about the middle of July. So on the assumption that this is the 80-day cycle trough, we would have expected a 20-day cycle trough to occur in about the last week of May. And you can see that over here, price came down and almost touched the 20-day FLD, which makes that a very likely position for that 20-day cycle trough. Price is next going to come down and probably cross below the FLD, reach below it, and extend an equal distance below the FLD to form the 40-day cycle trough, which we're expecting in about the second week of June. And then, of course, it'll carry on moving up and down, and then eventually come down to this 20-week cycle trough in the middle of July. So those are the implications of this analysis. Now, I would like to switch to the other analysis and have a slightly more complex discussion about the possibilities in that analysis. Now, I know not everybody manages to watch the entire video that I record, but I should say that I think that the discussion coming up is fairly important, and it's something that you need to keep aware of. So here is the analysis that we had been tracking over many months. The important details are the 18-month cycle trough in late December 2018. I think that was in fact Christmas Eve or something like that. And then we had a 40-week cycle trough over here in early October of last year. And then, of course, we were considering the 20-week cycle trough having formed over here, and in my previous market update video I discussed the likelihood that that 20-week cycle trough had formed over here on the 23rd of March. So what are the implications of this analysis? Well, the implications are very different because, of course, the very big trough that we are expecting has not yet formed, whereas in the other analysis it had formed. So here we've got a very displaced 54-month cycle trough, but I'm not going to spend time explaining that now. We'd have to add another 20 minutes onto the video to go through all of that detail. But the point is that we are still therefore expecting the really big trough to happen, and we're expecting it still lying ahead of us. This analysis seems less likely now, and you have to do a little bit more influencing the analysis in Sentient Trader software in order to achieve this analysis, because it's not an obvious analysis, but it is still a possible analysis, and it's one that we need to be aware of, because there is still the danger that prices are going to come down fairly heavily into this trough in about the middle of August. Now, the title of this video was Common Sense, and I said I would make a few comments about the concept of common sense in financial markets. There was a comment made on my previous market update video. Somebody pointed out absolutely correctly that the idea that the markets were turning bullish, and that previous market update video was at the beginning of April. So at the beginning of April, the idea that the markets were going to suddenly turn bullish when we were in the early stages of the COVID-19 pandemic didn't make common sense, or didn't make sense. I can't remember the exact comment, but that was the idea. And indeed, that was absolutely true. And it raises many interesting questions, which I don't really have time to discuss now, but I would encourage you to look at some of the writings of Robert Prechter, the man who wrote the Elliott wave theorist, of course, Elliott wave theory, and he has an approach that he calls socionomics, and he discusses the lack of common sense or reason between financial price movements and what is happening in the world. And there isn't a direct correlation. So whenever I see a comment about that analysis doesn't make sense, I feel I need to point out that very often financial market movements don't actually make common sense. And it's a really important point. So what I look at when I analyze the markets is I try to put aside ideas of what makes sense and look at things purely in terms of what's happening in terms of the cycles. But quite an interesting thing potentially did happen around about this period of time in March. Hurst defined something that he called fundamental interaction, which was when what the cycles are doing to influence financial markets is distorted by fundamental events, whether that be an election in the United States or anywhere really, or whether it be a news event. Non-farm payrolls on a Friday are a really good example of very short-term fundamental interaction. And what tends to happen is you get a lot of volatility and the market moves very strongly in one direction. And depending upon the magnitude of the event causing the fundamental interaction, this might take place over several minutes or several hours, or several days, weeks or months even, although it's very rare to see a fundamental interaction over months. But potentially what we have seen with this very deep trough in March is an example of a very long-term fundamental interaction. You must bear in mind that a global pandemic is not something we've ever experienced in living memory. So it's quite possible that the sort of panic that was caused by the announcement of the pandemic could have caused some kind of really large-scale fundamental interaction. And so it's possible that trough on the 23rd of March was not only influenced by the cycles, and it was a 20-week cycle trough, but it was also influenced by fundamental interaction, because we had price move down very strongly and then bounce right back to where it was when it started. So that is a potential explanation, if you like, for why this is still a valid analysis. So let's take a closer look at this analysis and discuss what the implications of this analysis are then. So here again we have an 80-day cycle trough that has been found in the market. If you have a look at it, it's actually been positioned under this trough here. It's a very unsatisfactory position for the 80-day cycle, and the reason for that is because there have already been 72 days. And so the chances that 80-day cycle trough has formed, because of the fact that the market is now again moving upwards, are high. And so that 80-day cycle trough almost certainly does lie behind us now. So what are the implications of this analysis? Well, as you can see, we are expecting a 40-day cycle trough over here in about the first week of July, and then this really big trough over here in about the second week of August. Let's have a look at the implications of this analysis in terms of the composite model line, and I've already made many comments about the way in which this line is constructed, so I don't think I need to repeat that. One thing that is fairly obvious when we display the composite model line on this analysis is that this move down, which was a sort of a three-wave hesitation in the upwards move, it was not a strong move down, indicate that the other analysis is a better fit for recent price action, something to bear in mind. But in terms of the structure that is revealed by this composite model line, you can see we have prices rising for another week or two, and then we're expecting a strong move down, which is of course into this big nest of lows here in August. So those are the expectations that we have for the two different analyses. We're going to be looking for the move down into the 40-day cycle trough, which both analyses tell us to expect. The one analysis has it occurring a little bit earlier than this analysis, but nevertheless, that is the next trough to be looking out for. If price comes down to the 40-day cycle trough and then bounces back up again, then we will continue to favor the more bullish analysis. But if some bearish cracks start showing in this market, then we have this analysis to turn back to. I do hope that you found this market update interesting and useful. If you have any questions, please put them into the chat below the video or send us an email. Thank you for your interest in Hurst cycles, and I wish you, as always, profitable trading.